I think the biggest issue right now is for investors is I think we're in a bear market, and I think common stocks are probably not the area that I'm really looking at. I think gold and to a potentially even greater extent, and it's an area I'm doing some work on at the moment, silver is an outstanding opportunity with the precious metals. I started recommending gold stocks in the report back in February and March when I first started. At the time, as you probably remember, the market was rallying. There was a lot of talk about the recovery that we're into and how markets were going to continue in a bull market. At that point, I was advising people that was a bit of a furphy, and that I thought that the precious metals offered the best value at that point, and common stocks were there to be sold. I'm probably not as bullish on gold at the moment. We've had a pretty strong run over the past month or so. But one of the things I like to point out constantly is that gold is in a bull market, and when you've got a position in an asset that's in a bull market, you ride that bull market for as long as you can. You use pullbacks to increase your position. Don't trade in and out of it. You just hang on there. So my sort of view is with the gold market, whenever we get a decent correction, I'll be looking to re-recommend some of the exposures we've got. Silver is a very interesting play at the moment. I just started writing about that last week, and I think it's difficult, or much more difficult in Australia, to find silver exposure, but there are some opportunities out there. But one of the points I made, silver's gone from a gold-silver ratio of 16 to 1 to 66 to 1 over the last 100 or so years, which effectively means silver, if you believe that silver still represents money, is extremely undervalued. So that's one of the areas that I'm looking at the moment. One of the other points I like to make is that it doesn't matter where the market's going, there's always going to be individual stocks in the market that have been sold down for whatever reason and do represent good value. I think there's probably limited opportunities at the moment. We've seen a lot of stocks like Elders is a good example, sold down heavily. Not a good stock, it's not an opportunity that I think I'd be looking to get into based on the fact that it might have fallen 95% in the last 2 years or whatever that might be. But still, there are opportunities out there when a stock does fall in price. And look, even though it's not the best company out there, I think Telstra was a good example of that. It's been under a lot of pressure over the past few months with the government regulation, but essentially it's a very solid company. It's not going to blow your socks off with share price return performance, but with a bit of capital gain and a good income, they're the sort of opportunities that you can pick up in this type of market. And Telstra was a stock that I had been recommending to members as well. So look, to answer your question, I don't think there's a whole great deal of opportunities out there in terms of common stocks. I think the risk for the market is probably to the downside over the next couple of months, but I am still seeing individual stocks that do represent good value and are worth sort of looking at in terms of investing. When a stock's below intrinsic value and deeply discounted to intrinsic value, it doesn't really matter what the market does. If you buy that stock at a deep discount, in time you'll make some money out of it.
Well, I guess that's the last question I want to ask, or next to last question I want to ask is, how do you know when that point is? There are a lot of different approaches in the value investing world to what intrinsic value means, and not everyone is familiar with that. But in your particular case, with your approach, you say we're in a bear market, but you're going to focus on picking stocks that have good intrinsic value. What specifically do you mean by that?
Yeah, and it's a good question, because there's a lot of value investors out there that talk about cheap stocks but don't actually talk about their methodology and how they go about determining whether a stock is cheap or whatever. For listeners who probably aren't too familiar with the process or the valuation methodology, what I really focus on is a company's return on equity, and to a lesser extent its return on capital. Effectively, you are giving, or you are investing in a company's equity. So you want to know as a shareholder what that return on equity is. Now, a company with a high return on equity is generally a company with a very strong business model, good management, and a whole range of positive attributes can be attributed to that company if it's got a high return on equity. So that's one of the first things I look at. Secondly, you need to put in what's called a required rate of return into your model in order to determine what rate of return you want to get from a stock. So my rate of return is 12%. For smaller and more risky stocks, I might go higher to 13 or 14%. Now, effectively, the rate of return determines the value that you're willing to pay. So I can put in a 5% rate of return into a stock and get a very high value, and say that stock is undervalued purely because I've got a very low hurdle rate. The higher your hurdle rate, the lower the price you need to pay in order to achieve that hurdle rate. So I think it's very important to make clear, and this is what I do in the report, is clearly tell my subscribers what rate of return I'm using, what are the parameters in order to arrive at that valuation. And as an example, I remember I was at CNBC doing an interview a couple of weeks ago, and I spoke to one of the brokers at, I think, one of the big investment banks, and I asked him about he was telling me how cheap the market was, and I asked him what rate of return they were using in order to come up with their valuations. Firstly, he wasn't too sure, and secondly, he said, I think it's the WACC, which is your weighted average cost of capital. Now, that's very much a hypothetical or academic look at what your cost of capital is or what your required rate of return is. Essentially, he didn't really know, and I think that's one of the issues, that you can come up with whatever value you want in a market as long as your required rate of return is low enough. And I think 12% is a fair return to expect for an investor who's investing in the equity market. It's got a decent, what we call an equity risk premium, which is the premium you pay over and above a risk-free asset such as a government bond. And I've found over the years, and I've used this for quite some time, I've found over the years, when you use 12% or higher and you buy below that amount that the valuation model gives you, you tend to do pretty well. Of course, there's many other things that you need to factor in. You need to judge whether the return on equity or the profitability of the company is sustainable, whether it's going to fall, whether it's going to increase. There's many other things to it, but they're the main things that I look at for a company. And it's probably one of the reasons why I steer clear of companies that you just really can't determine whether they just had one good year and they're due for another bad one the next year. So companies need to have some sort of track record or need to have some sort of reason why I expect the profitability to either be maintained or to increase.
Well, just three quick things on that. 12%, that's nearly twice the government bond rate. Does that make it kind of a super return on equity, like a super profit?
I'm looking for super profits, Dan. So I guess in the definition of many out there, I would be a super profiteer.
Well, why specifically 12%? And then how has it done for you so far since you started the report? Is it working?
Yeah, look, why 12%? I think that the way I view the market, when the market is fairly valued, many companies trade around their intrinsic value when I put it into the model as at 12%. When the market panics and you get into a deep bear market, you see that companies are discounting, investors are discounting returns at around 15%. So that's a pretty good time to buy in. When the market's very overvalued and there's a lot of optimism out there, investors are discounting the returns at around about 9%. Funnily enough, 12 just sits in the middle, and it's a non-scientific way of saying this is what I think is a fair value for the market. And look, it's done well for me so far. I mean, I haven't been out there recommending a whole bunch of stocks. My view is quality over quantity. But certainly I can say every stock that we've recommended since inception is up. There's some stocks are well above. I think the best performing stock is about 70% above the recommendation, and the next or the lowest stock is about 3% above the recommended price. So really having that focus on intrinsic value keeps me away from making mistakes, keeps me away from losing money, and the focus, I think, for everyone should be making money.
Oh, that's great, Greg. I mean, I think since you started, the market overall, the S&P ASX 200 is down almost 8%. So if you're able to generate that, you're definitely not riding the coattails of the market. So that's a good sign. Yep,
oh, definitely. And look, it's something that I think requires discipline and it requires patience. And I often make the point that the psychological nature of an investor is his or her biggest enemy. Often you get into the market, you want to start making investments straight away. Often it's just better to sit back and do nothing. And I think there's certain times when you're going to be far better served by doing nothing and observing the market. And then there comes times where you need to move, and you need to move quite quickly. And you know, the valuation techniques that we use certainly help us to do that.
All right.